we'd like to thank you all for joining us here for our 10 for 10 series featuring Jason White today. We're excited to have you all. This is being recorded, and everyone that RSVP'd for this will both be getting a recording of the presentation and then also a copy of the slides so you can share them with your different organizations. I'll be monitoring both the chat and the question and answer. So if you have something that pops in your mind, have a question about, we'll either interrupt Jason and insert that, or we'll address it at the end of the webinar, depending on the question. So with that, Jason, thanks so much for hosting us and preparing for this, and we'll let you take it away.
All right, thanks, Danny. Welcome, everybody. We've got kind of a trifecta day today. It's the day before we start the Labor Day weekend. We had the blue supermoon last night, and then opening night for the Utes tonight. So before we get started, cheers, and let's go Utes. We're going to just go into a couple of features tonight on selling the 504. And then some of the key selling points on that. So we'll be covering that. I'll do my best to try to keep this to 10 minutes and just cover a few specific things. So selling the 504, why it might be a product that is useful specifically in the current lending environment right now. We'll talk about kind of 3 bullet points. One, benefit for the borrower, at least cash intensive option to purchase a piece of commercial real estate. So today where cash is king, and either there's cash restraints from the borrower side where they may not be able to afford a conventional loan, or even if they've got a healthy cash position and maybe a candidate for a conventional loan, why it may make sense to do a 504 as well. We'll talk about the interest rate, why the 504 is kind of favorable, especially in this environment from an interest rate standpoint. And then the stability that comes from a 504, as many of you know from your own bank portfolios, it's been a little bit of a wild ride with interest rates. And the 504 provides some protection from that. So we're going to talk about that. I want to point out this little meme here. I think we'll probably do maybe a pair of Mountain West socks to whoever but can identify the neighbor that might be watching this guy suntan in the backyard. So as you're out suntanning this weekend, just make sure that you know where your neighbors are, and anybody that can shoot Olivia, the first one to email her who this neighbor might be, we'll send a pair of socks out to you. All right, slide 1. So injection advantage, today's lending environment, I don't know if you guys are hearing this. I'm sure you are in your credit committees, but it's coming up a lot. What kind of cash position is our borrower in once this building is purchased and we've taken a big chunk of it to put in as our injection? So that's maybe the number one criteria. The first thing to look for when you're looking at a potential loan is what the injection requirement and what that impact is going to be on your borrower. So SBA allows for 10%, as little as 10% when it's just a cookie cutter building, general use in an existing building. It's much smaller than what your conventional stuff is, where you're looking at 20 or 25%. Special use, 15% injection on the 504, and you can get up to 40% on special use properties in the conventional portfolios, where it's a property that the bank may not be super excited about. So, the little key phrase on this is we're going to call this protect your borrower's piggy bank, or protect your borrower's piggy. The other thing from the lending side, we'll see some deals structured where, we're taking all of the borrower's injection or cash, putting into an injection. And in a good market, the bank likes to do that and then maybe give a working capital facility to replenish that cash. Little different environment today where the line of credit, the unsecured money is a little harder to come by. And so, one thing to keep in mind is it may make more sense now on what might have gone conventional previously, piggybacked with a line of credit to replenish cash. It may be better just to do for your borrower and the bank to require the lower injection amount and have that secured by the piece of real estate and self-finance the working capital that's there to be left, versus the bank have to go out and exposure with unsecured line of credit type money. So the takeaway for this one, Just a quick example of what this looks like from a borrower. This is the plain Jane $100 million purchase. Borrower's got 250,000 cash. They come to the bank and want to know what their options are. From a conventional standpoint, that second bullet, you're going to take up most of that cash to get to a 25% injection. You lend 75%. You've got zero cash left, and you've got a working capital issue. You either make a line of credit to replace it, and depending on how healthy the business is, that may or may not be super palatable. Or consider the 504. It's a 10% injection. Your borrower's left with $150,000 cash. Working capital position eliminates the need for any additional financing from the bank, and you're good to go that way. So bullet number one is protect the borrower's piggy. Try to leave them as much cash as you can post injection in an environment where real estate money is still the easiest money to borrow. So if they get skinny on a working capital standpoint, or you leave them with minimal cash, it's not as easy to go get the line of credit for the business as it used to be. So in an environment where cash is king, the smaller injection requirement of the 504 may make a whole lot of sense, and it preserves the borrower's piggy. Number two, the interest rate advantage. We'll start this one off with just a quick look at some of the dynamics that we're seeing in the market right now. So let's take a business that's got $1 million debt load on their property. In this instance, we'll call it a 7A loan, prime plus 2.5. Loan didn't look that bad a couple of years ago, and today it's at 11%. Every one of you guys have seen these. Borrowers are kicking and screaming to get out of them because it's been a big rise on the impact on them over the last several 18 months or so. So what that loan looks like: $1 million debt load on a 7A at prime plus 2.5. The payment's $9,800 a month. Annual debt service is $117,000. That exact same debt load under the structure of a 504, and we've made an assumption that the bank's at 8% on their 5 or 10-year money rate. SBA is at 6.57 on. That's a refinance rate. We'll just assume it's a 7A refinance on this case. But you can see what the difference is and the drastic savings from a payment standpoint. They go from $9,800 a month to $6,900 a month. So it's almost $3,000 a month. About a $33,000 savings on an interest rate loan. So interest rate is a huge advantage right now. Makes the 504 really is maybe as easy to sell right now as it ever has been. So from that standpoint, and in a comparison rate, even a conventional loan, we'll go to this next slide. One more thing to point out on this slide, your debt service coverage, and again, this is zero influence from the company's performance. But your debt service on refinancing a loan looks like this. You go to take it from a 1-to-1 and you put the new 504 money onto it, and all of a sudden you've got a 1.4 times coverage. So we'll talk a little bit about that on this next slide. But those of you who have felt like it's a tighter lending environment in the last little bit, and you go home and your wife or your spouse is saying, hey, you haven't been able to make it rain for a while. These gifts aren't working, but you've got a banker here on the left that's making it rain, and you catch a little bit of the excitement from the borrower side, where they're catching this extra $33,000 a month on $1 million loan that you've just turned off and put in their pocket simply by refinancing them or putting them into a 504 versus what a 7A loan might look like. So takeaway number two is the interest rate advantage, huge selling point of the 504 right now, and probably maybe the main driver of why you want to put them into one. Next one, these is really bank and borrower centric as far as the stability that comes from one of these 504 loans versus what some of the alternatives are out there. And the last, I'm young enough. There's a few of you on here who may have been around during the Great Recession and can, dismiss what I'm about to say. But for a lot of us, this has kind of been our first inflationary cycle, and for sure, the first rate cycle we've seen where rates have risen like this. And so just from a stability standpoint, I want to talk about a loan that maybe was made under a 7A. Let's just use that same example from a couple slides ago. $1 million that was lent in 21 at prime plus 2.5. That was a 5.75% interest rate then a couple years ago. Payment was $6,200. You underwrote it to 1.15 debt coverage. Typical what an SBA loan might look like, and wasn't a bad loan right now at that point. Prime, that variable rate had been down for a long time. We had a good run where the variable rate wasn't that bad of a loan for these real estate deals. Jump ahead to today, and that loan is now at 11%. Payments jump from that 6,200 to 9,800. You've gone from that 1.15 times debt service coverage. That debt service coverage now writes at 0.74, and this is all assuming that business's performance is flat. Nothing has changed other than the loan that they've got on that real estate. And so the instability that comes from those 7A loans, the variable rate ones at least on this real estate, has never been felt more than what they're going through over the last 18 months or 2 years. You can see what the impact on that loan looks like, not only for the borrower, but for your credit reviewers when they're monitoring these loans. Some of you are RMs and monitor your own portfolios, and you get financials and revenues, cash flow. It all may look pretty similar to when you wrote that loan. But now all of a sudden the debt service coverage is so heavy, and something that covered over 1 times a few years ago is now down, not due to the business failing. And so there's some stress both on the customer side and from the bank portfolio side on those loans. And we just want to remind everybody that the 504 is still a really good alternative to refinance those and offer in lieu of those in the current rate environment. So the stress that you're seeing on these 7A portfolios, that hasn't been the case on the 504s. A 504 made in 21 or 18 or 19 has not felt this stress, and it's stayed exactly what it looked like with the day that you underwrote it for your bank and for that borrower. So big difference in this kind of a cycle on what a 7A loan looks like for both borrower and bank versus what a 504 loan looks like both for borrower and bank, and the implications for your portfolio. Next one. So with this stability, and so we want to leave that takeaway number 3. We're going to tap into the Yellowstone crowd here. Every ranch needs a fixer, and what credit guys are looking for right now is something that can bring some stability back to the portfolio. And how do we keep making loans and keep it safe? And I just wanted to invoke the Rip Wheeler image here as kind of the 504 being the fixer of some of the haywire and unpredictable nature of the lending environment right now. Stable, fixed for life payment for a borrower, tied to their most expensive and their most valuable asset. If your most valuable asset is what's become an anchor for your business because it's stuck in a variable rate, and you've seen the cost of that money increase so much over the last few years, it's not an ideal situation for your real estate. So the 504 can bring some stability to that, huge rate savings, and brings that down. From the bank side, same thing. And one of the things you're going to be feeling, if you're not already, from the credit side of your banks is what are going to be the implications on the values of the real estate. Office space in particular is probably going to feel some stress. And so there's some chatter that not on the sales line, but on the back end of things, as far as, hey, if we start seeing some decline in some of these property values, how can we best handicap that and make our loans in a way to kind of hedge that bet for us. And the 504 is again an excellent product to hedge your collateral risk, and to leave yourself some cushion from a collateral standpoint, to where you don't have a 75% loan right now on an office building that in a year from now you worry about being at 95 or 100% loan to value if there's a decline in those collateral property values. So again, if there's one thing to remember, it's the 504 is the Rip Wheeler of commercial real estate loans. It's the fixer. You can fix all kinds of pain right now in the market with these 504 loans. The other one from the bank side, when you're talking about what kind of loan to give your borrower to your credit folks, is these 504s are, if you're under some lending constraints as far as capital, how many of you have heard, hey, let's prioritize deposits over loans right now? I know a ton of you are hearing that. If the bank's got some capital constraints, this 504 product is an excellent way to stretch your loan dollars. Instead of taking on 75 or 90% of the loan on a 7A, the 504 lets you tell the customer yes, and you're only carrying 50% of the loan balance. So it's a useful product both from the stability and rate for the borrower, but from a portfolio management for a bank, it's a pretty good asset to be considering, or pretty good product to be considering as far as how you're lending out your dollars in the current environment. So those are the three things for me. That's 10 for 10. I think we're pretty close on time, but we'll turn this back over to Danny and try to take care of any questions you guys might have. Thanks.